Welcome. Thank you for tuning in and joining us as we break down the latest filing from, well, one of the most interesting companies shaping the future of global travel.
It really is.
And if you want more analysis like this delivered directly to you, please just take a moment right now, hit that like button, share this conversation with a friend who needs to be well informed, subscribe to the channel, and definitely stay tuned.
Because we are about to make the complex story behind these corporate numbers incredibly clear.
So today we are tackling the quarterly report on Form 10Q for Airbnb Inc. That's ticker symbol ABNB.
And this covers the critical period that ended on September 30, 2025. This is far more than just a routine financial document.
Right.
It's a crucial one because Q3 historically represents the absolute peak season for global travel, the summer months. This quarter should really showcase the company at its best, its maximal operational efficiency and profitability.
Absolutely. Our mission here is twofold. First, we need to extract the essential financial health and the operational insights from this dense filing. We want to give you the shortcut to being thoroughly informed.
And second, and maybe more importantly, we're looking for the story behind the numbers. We want the narrative that explains why the market reacted the way it did and what ABNB is really prioritizing right now.
And that story has a fascinating central paradox this quarter.
It really does. On the operational front, ABNB delivered exactly what you would expect. Solid top-line revenue growth clocking in at 10% year over year, and strong operational expansion with more nights and seats booked than ever before. It was a successful quarter by, almost every measure of scale.
But here's the hook. This is the central tension we need to resolve for you. Despite this robust top-line success and all that operational strength, the reported GAAP net income growth was essentially flat.
Flat.
Revenue is up 10%, but net income is up by a mere $6 million. That flatlining of profit, even in their peak season, it just hints at some serious underlying factors.
Exactly. That small, almost non-existent growth in net income points directly to a squeeze. We see evidence of significantly rising operational costs, which we will definitely get into, and critically, a massive one-time tax accounting impact that just fundamentally skewed the entire profitability picture.
That flat net income point, it fundamentally changes the investment thesis if you don't dig deeper.
It does.
So we're going to give you the plain English summary, zero in on the 5 most critical takeaways that solve this paradox, and look closely at where this market leader is directing its cash flow.
Especially regarding its accelerating international growth and the, let's say, increasing regulatory hurdles it faces all over the globe.
So let's start at the foundation. If the engine is running hot, we should see it in the booking data.
That's the place to begin.
The core measures of scale are where we always begin. ABNB is a growth story driven by volume. For the business to expand, they just need more people booking more stays. It's plain and simple.
So what did those foundational metrics, the nights and seats booked, show us this quarter?
They hit 134 million.
134 million in Q3 2025. That is a solid increase. It's up 9% from 123 million in the same quarter last year.
And considering the massive scale ABNB already operates at,
Yeah.
Achieving a 9% year-over-year growth rate in your fundamental unit of consumption, that's a strong operational achievement.
It really is. It means the platform is successfully attracting millions of new hosts or, expanding its penetration into existing host markets. It's working.
A 9% growth in volume is excellent, but volume alone, it doesn't tell the full story. We have to look at the financial value associated with those bookings.
The gross booking value, GBV.
Exactly, and the GBV grew notably faster than the physical volume.
It did. GBV reached $22.9 billion in Q3 2025. That represents a 14% increase from $20.1 billion the prior year.
Okay, so that disparity, that gap between the growth rates, is where the true operational insight lies.
This is where it gets really interesting, and it's why you pay close attention to these filings.
Right. When GBV growth, which was 14%, outpaces the nights and seats booked growth, which was 9%, it implies a roughly 5% positive change in the average value of each transaction.
And that is the crucial average daily rate, or ADR, factor. This divergence, it signals that ABNB is not just relying on selling more volume, they're also getting a higher value per booking.
So this implies a modest but really powerful increase in the ADR.
Exactly. And this lift could be driven by a few things. Either hosts are just charging more, travelers are choosing higher value, more premium listings, entire homes over single rooms.
Or maybe the average length of stay has increased a little bit.
Could be any of those. But regardless of the specific mix, the implication is quality growth. They're generating more revenue per transaction, which, typically translates to higher efficiency.
So you have this combined boost 9% volume, plus that 5% value, and that fed directly into the top line.
Which is why total revenue for Q3 2025 landed at $4.1 billion. That's a 10% increase from $3.7 billion in the same quarter last year.
It's also worth noting the critical check the 10Q offered on this revenue growth.
The constant currency comparison.
Exactly. The revenue growth stayed at 10%, even when you adjust it to remove the impact of foreign exchange fluctuations.
And that is such a key piece of de-risking data for anyone looking at this. Because ABNB operates globally, a strong dollar can make foreign earnings look smaller.
Or a weak dollar can inflate them.
Right. So the fact that the growth rate held steady at 10% on a constant currency basis, it signals that this growth wasn't just some lucky windfall from favorable currency moves. It was fundamentally organic and operational.
Driven by those check-ins and that higher ADR we were just talking about.
And we must always remember the seasonal context here. Revenue for ABNB is recognized when the guest checks in.
Right.
So Q3 captures that peak Northern Hemisphere summer travel season, particularly in their major markets of North America and EDA. This explains why Q3 is historically the company's highest revenue quarter by far.
And when we look at the geographic expansion drivers, that seasonal peak is highly visible. Let's review the revenue breakdown to see where the money is concentrated and where the growth strategy is focused.
Okay, so North America, or NA, brought in a strong $1.619 billion for the quarter, but EMEA, that's Europe, the Middle East, and Africa, actually led the way with $1.969 billion.
So together, those two regions are the absolute economic backbone of the company.
Absolutely. They account for, about 87% of that $4.1 billion top line. They provide the stability and the bulk of the cash flow.
But the strategy for future growth, that's clearly revealed when you look at the trajectory in the less mature but rapidly developing markets.
That's where it gets exciting. Latin America, or LATAM, reported $235 million in revenue, and Asia-Pacific, APAC, posted $272 million.
These markets are smaller, of course, but their growth rates tell the real story.
Precisely. While NA and EMEA provide the bulk of the dollars and the operational scale, the 10Q emphasizes that the fastest percentage growth in nights and seats booked in GBV was specifically observed in LATAM and APAC.
Which reinforces everything management has said in their forward-looking statements. They are prioritizing global expansion and diversification away from that heavy reliance on North American and European markets.
It's the classic land and expand model working exactly as intended. The mature markets provide the stable foundation and the cash.
And the younger, less saturated international markets are providing that incremental, high percentage growth that you need to sustain the overall 9% volume growth number.
So the operational engine is clearly performing. They are scaling volume and increasing transaction value. The logical next step would be record profitability.
But that hadn't happened.
And that's the question. At what strategic and regulatory cost is this international acceleration being funded? This leads us straight to that flat net income problem.
Okay, we've established the engine is running hot, but now we have to look under the hood. And when we start examining the fuel costs necessary to power this kind of international acceleration, that's where we run headfirst into that flat net income problem we mentioned at the start.
So let's just nail down the numbers again. Revenue grew 10%, ADR increased, volume was up, yet net income for Q3 2025 was $1.374 billion.
Which is a virtually flat increase of only $6 million compared to the year before.
And this isn't just about the dollar figure either.
No, the result was a measurable drop in profitability. The net income margin fell from 37% in Q3 of 2024 all the way down to 34% in Q3 of 2025.
That 3-point drop in margin in their peak quarter is significant. It happened because total costs and expenses grew by 12% to $2.47 billion.
Outpacing the 10% revenue growth.
Right. And when costs grow faster than revenue, especially in a scaled marketplace business, you have strategic margin compression. Management is either consciously choosing to invest for future growth or they're seeing involuntary cost inflation.
So we need to trace exactly where this money is going across the expense categories to figure out which one it is.
Let's start with cost of revenue. It jumped 18%.
18%, that is a massive hike for a core operational cost.
It is. The cost of revenue increased by about $84 million year over year, and the largest driver by far was a $78 million increase in merchant fees.
Okay, so what's behind that?
This cost increase is twofold. First, it's just due to higher pay-in volumes as the platform scales globally. More transactions simply means more processing fees.
Makes sense.
And second,
This is the subtle but important detail. They received fewer incentives and credits from their card processor relationships compared to the prior year.
okay. So ABNB likely negotiated some favorable terms or volume rebates in the past that have either expired or were reduced.
Exactly. This means the actual per-transaction cost of processing payments has effectively gone up. It's impacting their gross margin purity. They are paying a higher true cost for the same payment services.
So part of the squeeze is just a normalization of payment costs, a fundamental building block of the marketplace.
Okay. Next, let's look at product development. That increased by 12%.
Another significant investment, especially when you see it's tied to headcount. Product development saw a $63 million increase in the quarter.
And the 10Q says this is primarily due to higher payroll-related expenses driven by an increase in average headcount.
It's a deliberate, strategic investment in the future of the platform.
So if we look at their strategic priorities, where are these new engineers and product managers likely focused?
They are pouring money into their multi-year product roadmap. This could involve several key areas: enhancing the host tools to improve supply quality, maybe deeper integration of AI for personalization and search,
Improving platform reliability for instant booking.
and crucially, developing the compliance technology they need to navigate the increasingly complex regulatory landscape in Europe and Asia. That $63 million is the expense of future-proofing the platform.
Okay, now let's talk about the biggest percentage jump. Sales and marketing, S&M. It soared 24%.
24%.
When a mature platform like ABNB, which historically boasts high brand recognition and relies heavily on direct and unpaid traffic, boosts S&M by nearly a quarter. That catches your eye.
It really does. Does that signal a worrying increase in customer acquisition costs or maybe a softening of their organic brand traffic? That's the critical question.
A 24% increase in S&M, totaling $639 million for the quarter, is just enormous.
And while some of this is necessary to fund that rapid expansion we see in LATAM and APAC, you have to ask if the cost of acquiring that next user is getting structurally more expensive.
So where specifically did that spending go?
It was driven by three core components. First, a $45 million increase in just general marketing activities, traditional ad spend, channel marketing.
Right.
Second, a $32 million increase in payroll-related expenses. So they're hiring staff to manage or execute these larger marketing campaigns globally.
And the third component, that's related to the new product roadmap.
Exactly. A $31 million increase in third-party service provider expenses. And the 10Q was specific about this, linking it directly to the company's product launch and other initiatives.
Which means they're likely engaging external agencies, consultants, or specialized contractors pretty heavily to execute new product rollouts.
Or massive marketing blitzes designed specifically to penetrate those new international markets and drive the volume growth we saw in Section 1.
So they are actively investing, and investing heavily, to sustain that operational volume growth, particularly in those less mature regions. They're willing to accept margin compression today because they're aggressively buying market share and scale for tomorrow.
It reframes the cost. It's not necessarily inefficient spending, but strategic overspending.
Right. Finally, let's look at general and administrative G&A. The source noted a slight decrease of 1% year over year, which might look like good fiscal control at first glance.
But the 10Q reveals that slight decrease was deceptive. It was entirely due to a prior year one-time charge related to digital services taxes, DST, for France that just did not recur in Q3 2025.
So had that specific prior year charge been absent, G&A would have likely increased.
Absolutely. The non-recurring costs masked underlying inflation, which was partially offset by a smaller $15 million increase in payroll and other non-income tax-related fees and penalties.
The takeaway here is crucial. Even where the cost line item looked flat or down, the underlying core operating expenses were still rising. They were just hidden by accounting noise from the year before.
And this is precisely why we have to look beyond GAAP net income. We rely on non-GAAP metrics to get a cleaner picture of core operational health, stripping out stock-based comp and unusual charges.
Let's look at adjusted EBITDA.
Adjusted EBITDA for the quarter was $2.051 billion, which is up slightly from $1.958 billion last year. But the adjusted EBITDA margin, which is designed to show that core operational efficiency, still fell.
From 52% down to 50%.
Exactly. The fact that even this adjusted cleaner metric shows margin compression confirms that the core operating expenses were structurally higher. It tells us that management is indeed strategically leaning into spending to achieve scale.
And that's independent of any non-cash accounting or tax issues.
Right. And before we move to the massive cash flows, we have to address the interest income decline. This dropped 13%, a reduction of $27 million for the quarter.
And the 10Q attributed this specifically to lower interest rates, which was partially offset by the higher cash balances they hold.
This is a macroeconomic trend to watch for any tech company holding massive cash reserves. As global central banks potentially signal softening interest rate environments, relying on passive investment income from cash just becomes less lucrative.
For ABNB, $27 million is a noticeable reduction in ancillary income.
That said, despite the cost increases, their liquidity position is still monumental, which brings us to Section 3, financial strength and capital allocation. The sheer amount of cash they generate is a story unto itself.
We need to start with what truly sets ABNB apart, their formidable liquidity position, what we call the cash fortress.
Right. As of September 30, 2025, ABNB reported total liquidity, that's cash equivalents, and short-term investments of $11.7 billion.
That is a staggering amount of capital. But we have to immediately introduce a crucial detail that the 10Q explicitly defines.
The distinction regarding customer funds.
This is absolutely critical for you to grasp the true discretionary cash available to management. Of that $11.7 billion, $7.2 billion is specifically categorized as funds held on behalf of customers.
And that customer money has a corresponding liability on the balance sheet. It is cash they've collected upfront for bookings that have not happened yet.
It's basically an interest-free loan to ABNB until the guest checks in.
Exactly. So, while it contributes to the large cash balance, it is not truly discretionary company cash that they can use for buybacks or investments. The real war chest is smaller, but still incredibly powerful.
The core of their financial strength, therefore, doesn't just lie in the balance sheet snapshot, but in the recurring massive free cash flow power that's just inherent in their marketplace model.
The FCF for Q3 2025 was robust at $1.349 billion. And crucially, this was a significant increase from $1.074 billion the year prior.
And this translated to an impressive free cash flow margin of 33% in the quarter.
Which is an improvement over last year's 29%.
So why does this FCF margin matter so much?
Because it indicates the immense, sustainable, and improving cash-generating nature of the marketplace model. Even when GAAP net income is soft because of strategic spending or accounting charges, the fundamental business structure of collecting cash up front ensures they are generating huge amounts of liquid capital.
That FCF is the lifeblood and liquidity base for everything else they do.
And what they're doing with that cash is unambiguous. Aggressive shareholder returns. They are prioritizing capital allocation right back to the owners of the stock.
I mean, just look at the repurchase activity in Q3 2025 alone. The company repurchased and retired 6.7 million shares of Class A common stock for $857 million.
Nearly $1 billion dedicated to reducing the share count in a single quarter. It's a classic strategy to artificially boost your earnings per share.
But the real signal of management's confidence and intention was the board's decision back in August 2025.
Yes. They approved an additional $6.0 billion repurchase program. This brings the total available authorization to a staggering $6.6 billion as of the end of September.
That is a commitment to financial engineering on an astronomical scale. They are signaling to the market that they view their operational cash flow as structurally surplus.
They're generating more cash than they need to run the business and fund growth initiatives. So the only logical thing to do is dedicate that excess to increasing returns for shareholders via repurchases.
And this huge commitment, it takes on an even sharper focus when you view it against their major upcoming debt obligation next year.
Correct. The 10Q specifically highlights the $2.0 billion aggregate principal amount of 0% convertible senior notes that are due for repayment in March 2026.
So that's a material cash commitment coming up in less than 6 months.
Yet they're willing to dedicate nearly $1 billion per quarter to buybacks while simultaneously facing a $2 billion debt maturity. This prioritization just signals management's intense confidence that the FCF engine is so reliable that the debt repayment is a non-issue.
The company explicitly states that they believe their existing cash and the strong FCF generated from operations will be sufficient to cover this repayment.
It just confirms their financial resilience. They believe they can operate the cash machine, continue the buybacks, and meet a major debt obligation without breaking a sweat.
The SEF generation grants them immense flexibility, even in the face of rising costs and major regulatory risks.
So the operational story is high growth funded by high spending, and the financial story is immense cash generation directed heavily towards shareholder returns. Now let's pivot to the challenges, because the biggest squeeze on profitability came not from operations, but from the legal and legislative arena.
This brings us to Section 4, navigating global headwinds, the tax and regulatory minefields. And this section is absolutely critical because it provides the primary explanation for the paradox we opened with.
Why net income was flat despite 10% revenue growth?
Let's start with the major income tax impact, specifically the Corporate Alternative Minimum Tax, or CAMT.
The provision for income taxes increased 14% in Q3. This was driven by a massive non-cash one-time event, the recognition of a $213 million valuation allowance against deferred tax assets related to historic CAMT credits.
Okay, we need to pause and unpack that for you, because this jargon explains hundreds of millions of dollars of lost reported profit. What exactly is a valuation allowance in this context?
A valuation allowance is essentially an accounting charge. It happens when a company's management determines that it is no longer more likely than not that they'll be able to use certain tax benefits in the future.
And these benefits are deferred tax assets, things like tax credits that companies can use to offset future taxable income.
Right. And in this case, the benefits they determine they won't be able to use are their historic CAMT credits.
So why did those credits suddenly lose their value?
This goes back to a legislative trigger. The signing of the One Big Beautiful Bill Act, or OBBA, on July 4, 2025. This act changed several key tax provisions, most notably those related to the required expensing of research and development costs.
So the legislative changes forced ABNB to reassess its entire future tax position.
Exactly, because the OBBA changed the rules for how and when R&D expenses must be amortized, when they can be deducted. Management concluded that their future income stream and resulting tax liability would be structured differently.
And as a result, they determined they were unlikely to fully utilize those historic CMNT credits before they expired.
Which forced the recognition of the $213 million valuation allowance.
So to be perfectly clear, this $213 million tax hit is a paper loss, not cash out the door. But it's the single biggest accounting reason why the highly profitable story of ABNB looks flat this quarter.
It's the difference between net income growing by $6 million versus growing by over $200 million. Without this one-time non-cash tax charge, the net income picture would look dramatically healthier, which would validate the strong operational performance.
It really proves how sensitive corporate earnings can be to specific legislative shifts.
Absolutely. And that brings us to the ongoing headache of international regulatory and tax disputes. Specifically, lodging taxes and withholding issues. This exposes ABNB to persistent high-cost battles across dozens of different local jurisdictions.
They face these battles constantly. Regarding logging tax exposure, ABNB estimates a reasonably possible loss in excess of what they've already accrued is between $55 million and $65 million.
And this reflects ongoing disputes where various local governments assert that the platform is jointly liable with hosts for collecting and remitting transient occupancy taxes, like hotel taxes.
This reflects the constant tension of their operating model. ABNB sees itself as a neutral platform connecting people.
But governments view them as a crucial intermediary, a lodging provider even, with the responsibility and the deep pockets to ensure tax collection.
The compliance cost of navigating these highly varied local rules must be enormous.
And this cost is perfectly illustrated by the Italian settlements. This is a textbook example of the high financial consequences of regulatory noncompliance.
Right. In 2017, Italy passed a law requiring short-term rental platforms to withhold host income tax. ABNB fought this requirement legally for years.
And now we see the price tag of resolving those disputes with the Italian Revenue Agency. The 10Q details the cost of settling those audits.
Yes, the resolution of that past non-compliance has now been finalized.
For the 2017 to 2021 audit, they settled for 576 million euros, which translates to $621 million.
Wow.
The 2022 audit settled for 139 million euros, or $150 million, and the 2023 audit settled for 179 million euros, equating to $186 million.
So you add all that up, that totals a monumental cost of $957 million in historical tax settlement with a single country.
Nearly $1 billion. This money flowed out of the business over a short period to resolve past liability.
This is a near billion-dollar price tag that really redefines the cost of doing business in highly regulated global markets.
And the crucial context here is that ABNB has now started the required withholding on host payments in Italy, starting in 2024. This shows they are now structurally changing their platform to manage these liabilities proactively.
Which is a necessary operational cost going forward.
And it's not just income and withholding taxes. Regulations on short-term rentals themselves are also becoming a costly headwind. In July 2025, ABNB got a letter from the Spanish Ministry of Consumer Affairs proposing a huge fine.
The initial proposed fine was 110 million euros, right?
It was, but it was subsequently reduced to 65 million euros in September. This penalty relates to alleged noncompliance with local short-term rental listing regulations in Spain.
And ABNB is strongly disputing the fine, arguing the rules don't apply to them.
Right, so the possible loss is currently designated as neither probable nor estimable.
That technical language signals high uncertainty and confirms that this is an active, high-stakes legal battle that could result in tens of millions of dollars in losses.
So we have the one-time CAMT accounting shock hitting net income, and we have nearly $1 billion in aggregate Italian tax settlements clarifying the historical regulatory price tag.
All right, finally, let's wrap this section with a look forward at their strategic future commitments. They are locking in huge, multi-year fixed costs to ensure the future stability of the platform.
ABNB locked in 2 significant long-term agreements in Q2 2025 that will define their future fixed costs. The most financially significant is a new enterprise agreement signed in June for cloud hosting and related services.
And this is a staggering commitment.
It requires a minimum purchase commitment of $1.9 billion through 2031.
$1.9 billion.
This locks in their spending trajectory on technology infrastructure, ensuring the platform can scale globally and handle the massive volume we discussed earlier. It's a necessary expense for a global tech platform.
But it commits them to nearly $2 billion in cloud costs over the next 6 years, regardless of how revenue evolves.
And second, they signed a separate 3-year sponsorship agreement, totaling a minimum commitment of $55 million through 2027.
These 2 items, totaling nearly $2 billion, are non-cancelable commitments. They define a huge portion of the company's long-term cost structure.
And it reflects management's confidence in sustained, high-volume operational growth that will require that massive infrastructure investment.
Okay, let's tie this all together now. We've seen the high growth, the high spending, the immense FCF, and the regulatory shocks. It's time for the summary and the 5 most important takeaways that truly matter.
All right, let's provide the plain English summary of the 10Q, which has to solve the paradox we started with.
Right.
The company delivered exceptionally strong operational growth in nights booked, up 9%, and GBV, up 14%. This was fueled by successful international expansion into LATAM and APAC, resulting in 10% total revenue growth in Q3 2025.
That success was structurally sound, but the high operational cost to achieve that scale, particularly that 24% jump in sales and marketing and the 12% rise in product development, put pressure on operating margins.
And crucially, the entire narrative of the quarter was overshadowed by that massive non-cash $213 million tax valuation allowance related to the new CAMT legislation,
which severely limited the reported GAAP net income growth, masking what were fundamentally robust operations.
However, their liquidity remains exceptional, supported by that immense free cash flow machine, and that's the engine funding an aggressive, multi-billion-dollar share repurchase program aimed squarely at boosting shareholder returns.
Okay, now let's quickly review the core data points in a conversational list just to solidify the numbers.
Let's do it. Revenue, Q3 2025, $4.095 billion. That's solid growth of 10% year over year.
Net income, Q3 2025, $1.374 billion, showing virtually flat growth, up only $6 million year over year, primarily due to that one-time tax charge we discussed.
Diluted EPS, Q3 2025. Now, this metric observed the positive impact of the share buybacks. It climbed to $2.21, up from $2.13, even with the flat net income.
Margins, Q3 2025. Net income margin dropped from 37% to 34%. Adjusted EBITDA margin dropped from 52% to 50%. But crucially, free cash flow margin increased from 29% to 33%.
Which just highlights the financial model's fundamental strength. And for guidance outlook, there was no explicit Q4 guidance provided in this filing. Future operational efforts are focused heavily on global expansion, managing currency fluctuations, and of course, preparing for the repayment of those $2.0 billion convertible notes due in March 2026.
Now, let's synthesize all this detailed information into the 5 most important financial and operational takeaways that you must carry forward.
Okay, takeaway 1. High-quality growth with strategic margin pressure. The 10% revenue growth is high quality. It's driven by successful international scale and that positive ADR lift.
But the operational cost to achieve this expansion seen in that 24% S&M jump and 12% product dev increase is a conscious strategic choice. They are prioritizing future market share over current operating margin purity.
Exactly. Takeaway 2. Tax policy shock solves the paradox. This is the accounting key to the whole quarter. That $213 million non-cash valuation allowance against CMT credits triggered by the OBBBA legislation, it just significantly suppressed the reported GAAP net income.
If you strip this policy shock out, core operational profitability was substantially healthier. It really proves how quickly legislative change can distort quarterly results.
Takeaway 3. Regulatory liability normalization. The nearly $1 billion aggregate cost of resolving the multi-year Italian tax settlements is a defining moment. It forces the realization that operating as a global platform involves high-stakes government relations and legal costs.
This cost is being normalized. It's defining the high regulatory price tag for operating in global jurisdictions that demand tax compliance and collection responsibilities.
Right. Takeaway 4. Exceptional, growing cash generation. The FCF power remains the undeniable strength of the business model. FCF was robust at $1.35 billion, and the FCF margin improved to 33%.
This provides the massive liquidity and financial resilience base needed to fund all that strategic spending and navigate global volatility. It effectively decouples the company's financial flexibility from its reported GAAP net income.
And finally, takeaway 5, extreme focus on shareholder return. The board's authorization of an additional $6.0 billion for share repurchases signals a massive multi-year commitment to returning capital.
It confirms management's strong confidence that the core business generates excess cash beyond the needs of funding growth, investment, and even meeting upcoming debt obligations.
That is the complete, detailed picture of ABNB in Q3 2025. It's a fascinating dichotomy of overwhelming operational success and profitability being held hostage temporarily by aggressive strategic spending and massive necessary one-time regulatory and tax accounting charges.
So as we conclude this deep dive, we leave you with this final provocative thought, building directly on their capital allocation decisions.
The company has locked in a massive new $1.9 billion long-term cloud commitment and continues to generate consistently high FCF. Given this, will the next fiscal year see the cash machine slow down its intense focus on shareholder buybacks, that $6.6 billion authorization, to aggressively pay down the $2.9 billion convertible notes due in March 2026?
Or will they continue prioritizing capital returns, assuming the robust operating cash flows are simply more than sufficient to cover that maturity easily?
That is the ultimate test of their long-term capital allocation strategy and their confidence in the stability of that cash machine. We'll be watching closely to see their next move.
Thank you for joining us for this extensive breakdown of the ABNB Q3 2025 10Q. We hope you feel thoroughly informed and equipped with the necessary details.
If you enjoyed this analysis, please click the like button, share this deep dive with others who need to understand the story behind ABNB's finances, and subscribe to stay tuned for our upcoming content.
Thanks again for listening, and we'll catch you on the next deep dive.